Hi, good morning, ladies and gentlemen. My name is Ryan Cox. I'm the General Manager of Major Accounts at InfoTrack in the UK. I'll be joined this morning by Allan Wilen of Glenigan and Michael Clarke of Dehavilland to deliver an update on the residential and commercial property sector. Throughout the session, Allan will review the recent performance of the UK economy and how forecast recovery is expected to shape the construction activity over the next 2 years. The key topics that we'll include will be private residential sector, student accommodation sector, industrial construction and property, office retail, and hotel and leisure sectors. Michael will then turn to provide an assessment of the political priorities and events with a focus on the forthcoming autumn budget and the Brexit transition period in the new year. Allan has 30 years of experience in analysing and forecasting the UK construction industry. Allan heads Glenigan's Market Intelligence Service. Glenigan is the trusted provider of UK and the Republic of Ireland of construction project sales leads, market analysis, forecasting, and company intelligence. Its Market Intelligence Service provides clients with regular online comments and analysis on the construction industry, including sector and regional forecasts. The research draws upon detailed analysis of Glenigan's database of planned and active construction projects, as well as other economic and market data sources. In addition, Allan undertakes custom research and analysis for customers, including leading contractors, product manufacturers, and governments. Michael Clarke is the Managing Director of Dehavilland. His goal is to ensure the most relevant and highest quality content provision to help public affairs professionals track, monitor, and evaluate the impact of the political environment, enabling them to effectively plan, implement, and evaluate their organisation's objectives. A graduate of Queen's University Belfast, he has extensive experience of political monitoring and has also previously worked at the UN Department of Political Affairs. Just a bit of housekeeping. If any of our delegates have any questions, please feel free to use the Q&A feature and we'll endeavour to answer them all at the end. Please can you also ensure that you make comment of who your question is directed to. Allan, I'll hand over to you to begin your part of the presentation.
Okay, thank you, Ryan. Good morning, everybody. As Ryan says, I'm the Economics Director at Glenigan, and what I was going to do over the next sort of 20 minutes really is sort of set out how we see the construction industry faring over the next sort of 2.5 years really, but really taking into account obviously the very uncertain economic outlook we have currently for the UK economy. In fact, when we put our forecast together just in the summer, sort of the May-June time, clearly that was right in the middle of the lockdown and as a period of particular heightened uncertainty. And for that reason, we effectively took the unprecedented approach in terms of, as well as preparing our usual central forecast for how we saw the economy and then construction as a whole moving over the next 2.5 years. We really sort of actually had to take into account, well, you know, exactly how is the economy going to move? There's an awful lot of uncertainties there, and a lot rests on the assumptions. So as well as usual, looking at our economic data and the data that we hold on our database for individual projects and assessing how they're likely to unfold, we also had to do some further analysis to take into account the potential changes, the historical changes and relationships as a result of the COVID pandemic, and also make some key assumptions about the course of the economy and the pandemic itself. And from that point of view, we effectively constructed 3 scenarios: that our central forecast, and then a better case scenario and a worst case one. Now, the central forecast really assumed that we saw a big hit, May being the low point in terms of project starts for the industry, and then as from then on, we'd see reduced staffing levels and a gradual return to and reopening of sites. The UK would avoid a big second wave and an accompanying national lockdown during the winter, but economic growth clearly would be weak and disrupted, as would UK business revenues and confidence. Alongside that, we'll be seeing rising unemployment and weak household earnings. There would be increased government investment, and that's going to be a major driver over the forecast period for construction as a whole, not necessarily the sectors we're looking at this morning. And then there's the whole Brexit question at the end of the year, and the key assumption there we had was that there would be some limited treaty in place. Best case scenario, very similar but more rapid adjustment to working practices on site. Brexit process would actually see some greater political flexibility, and we'll see a faster delivery of government investment, all of which would mean a stronger recovery in the economy, consumer confidence and business investment, which again would support a more rapid recovery in construction activity. Now, the downside potential risks was clearly a significant second wave of the COVID-19 pandemic, requiring more severe lockdown measures. That basically the Brexit process would end either with a very limited or no trade agreement, and effectively the UK facing a cliff edge from January. Against that background, we would see even weaker economic growth. Public investment was also assumed to be slow to pick up, and therefore as a whole we'd see weak UK economic performance, and that would have a clear impact and knock-on effect in terms of UK construction. So those were the three key scenarios, and obviously our central forecast is the way we anticipated things to pan out in June when we published our forecast. Things obviously moved on, and we've got some more data, particularly for the second quarter and over the summer months coming through. In terms of our analysis, we track, for example, the value of projects starting on site each month and appraise on that. So we've got data up to the end of August now, and that's actually quite encouraging. Some positive signs coming through there, which suggests that actually certainly the initial downturn and the recovery in the third quarter has actually been slightly ahead of our central forecast, which is encouraging. And I can pick up a little bit more on that as we go through. I think probably a good place to start would be to look at the residential sectors. If you look at our forecast for overall, this is the value of projects starting on site. I think the key element here is the private housing side of things. Now, the house building sector actually was one of the sectors that was especially hard hit by the initial lockdown. House builders suspended more sites than a lot of other parts of the industry, and were slower to reopen those. And I think that was really a reflection of the nature of the sites and the ease of setting up safe working conditions to allow those sites to reopen. Now that clearly had a knock-on impact on starts during the second quarter. And where house builders were bringing sites back on stream, they were also prioritising the completion of nearly completed sites rather than projects that are in an earlier stage of development or bringing more projects on site. And I think that again, that reflected the nature of the construction process, as well as them looking at their cash flow. Having said that, if we look at what's happened post-lockdown, we've seen quite a bounce back in the wider housing market. There's clearly been some pent-up demand there during the lockdown period. We saw the stamp duty cut announced by the Chancellor, and the sort of effectively seen a re-evaluation of by some householders, by some homeowners, as to where they want to live. And I think that's encouraged more people to move. There's been a lot of interest from people wanting to move out of major conurbations, for example. So that's clearly it sort of caused something of a mini boom at the moment. The question is, will that be sustained during the autumn and particularly into next year, when that stamp duty holidays is scheduled to end, and we face sort of a weak economic growth and rising unemployment outlook. In addition, there's signs at the moment that banks are becoming increasingly cautious. The mortgage term lending terms that they're making available in terms of the amount of deposit is shrinking, and obviously that's going to particularly hit first-time buyers, who typically are sort of the lifeblood for the for new house sales as opposed to the existing properties. So all in all, if we look at the value of projects starting on site last year, private housing projects probably fell about 3.5%. Well, we estimate they fell out 3.5% this year, and we were scheduling a further drop by a third this year. So really quite a significant fall. As I say, it was very much disrupted during the second quarter, but things have started to come back. So it may well be a slightly less of a fall than the third drop that we had in our June forecast. But nevertheless, very weak performance for the current year. Looking ahead to 2021, we do anticipate a recovery. We're expecting something of a bounce back, 23% rise with a further 15% improvement in 2022. So strong growth recovery. Having said that, by the end of the forecast period, we're still down on where we were in 2019. So if you look at the student accommodation market, this has been a really strong growth sector for a number of years. Up to 2018, it grew very rapidly. Last year, however, there was a marked drop in the value of projects starting on site. We recorded a 29% fall, and we are anticipating a really substantial decline during the current year. Now, the fall last year does really seem to reflect growing concerns over future growth in student numbers at a time when obviously supply, as I say, has been growing of accommodation has been growing substantially for a sustained period. In addition, there's been some consolidation within the sector in terms of lenders, investors into the sector. Again, that I think has prompted a pause in new provision coming forward. Clearly, we've seen a direct impact of the lockdown and the general disruption, a sharp fall this year, and we are expecting some recovery as we get into 2021 and into 2022. But we do expect it to remain significantly below previous sort of high levels we saw between 2016 and 2018. And I think that really reflects that there are, a number of factors, not least that there's heightened uncertainty surrounding overseas student numbers, sort of post-COVID, post-Brexit, and given the current sort of political spat that's going on between China and America and Europe at the moment, all of which I think perhaps does raise a big question mark over the sector, given that overseas students are particularly important element in terms of tenant occupancy for this sector. Moving on to the industrial sector. Now, this sector is expected to remain strong overall and actually grow quite strongly. Last year, clearly there's been a disruption this year. We expect overall industrial starts to fall around 16% this year. But that's a much smaller decline than some of those other sectors that I've been mentioning. And we do expect a strong recovery as we get into 2021. Now, that's really being driven by strong demand for logistics space. And if anything, the current pandemic has actually exacerbated and intensified the demand for this space. We've seen a strong move boost to the already underlying trend in sales away from the high street and onto the internet. And that has, as I say, had a really significant boost this year. And that's why we expect that to be a real growth element within the industrial sector. As you can see from the chart there, that has been a sector that's been expanding, and we expect to continue expanding over the next 2 years. In contrast, I think the manufacturing element is going to remain subdued, really reflecting the weaker economic outlook, plus greater export uncertainty after the end of the transition period from the 1st of January. All of those, I think, will increase the caution among manufacturers, certainly about investing in new additional capacity. So we anticipate that to that element to underperform over the next couple of years, but the slack to be really taken up by that growth in logistics space. Moving on to the commercial sector, you can see a similar pattern of sharp fall this year, but a recovery overall in 21 and 22. But there are some quite significant variations and different factors and drivers that we anticipate will be at work within the individual sectors. So I shall look at those in a little bit more detail now. Starting with the office sector, this sector was prior to the pandemic was facing something of a cyclical downturn in activity, and now has obviously had the additional impact of the lockdown itself, and potentially some significant structural change in the demand and use of office space over the medium term. If we look at first at the more recent pattern of growth, we can see that actually over the last couple of years, development activity has been in the UK's major regional centres rather than in London, and there's been some real significant investment there. In fact, there's clear signs now that actually that has significantly improved the supply of high quality office space outside of the capital, to the extent that it is now expected to dampen new development activity going forward. In contrast, there have been some more encouraging signs of more development activity or more projects coming forward into the development pipeline in the capital. But now the interesting thing will be how that plays out over the next few years in light of the pandemic itself. And certainly this increased uncertainty now about Britain's trade negotiations and the medium-term growth prospects for the UK, and that is likely to impact on the demand for office space. In addition, we've now got the COVID-19 pandemic, which has prompted a real appraisal by tenants and occupiers of the amount of office space they required, its location, and effectively how they want to use that going forward. As a result of that, in our forecast, we are anticipating, after 25% fall this year, sort of a modest recovery in 2021, 9% rise, with a slight fall, 2% in 2022. So there is something of a recovery in the overall value of projects. But in terms of the amount of floor space that's under construction or refurbishment, that could be substantially higher. And the reason for that is, I think, is potentially a big switch in terms of less new development activity coming forward, but increased opportunities for the refurbishment of existing floor space, and also perhaps a substantial increase in subletting activities. Tenants really reappraise how they want to use their floors, their office accommodation, and where they actually want that accommodation to be, whether they want it in a sort of central hub or they want to have it more widely distributed so that it's readily accessible to perhaps a more geographically diversely spread workforce. The retail sector has been in decline for a number of years, as you can see from this chart. The high point was in 2016, and it's been a sort of a steady decline since then. The internet and online sales have really sort of caused a structural decline in demand for rental retail accommodation, and now that has now been accelerated by the pandemic. Prior to the pandemic, if you look at internet sales, online sales, they had steadily declined for over the last 5 or more years to account for about just over 20% of all purchases. During the pandemic, that had leapt to well over 30%. And whilst there's been some clawback as the high streets have reopened, actually it's not expected to go back to where it was. It's actually, the pandemic's actually encouraged a lot more people who perhaps had resisted online purchases. They've been sort of forced to do it, particularly about some of the sort of more established, sort of older population, and they've got into the habit now. So I think there has been something of a shift there. We've seen a lot of the supermarkets, for example, recognizing that and planning for a long-term increase in their delivery requirements. All of which means the amount of demand for office space, retail space, the decline there is likely to accelerate over the forecast period, and therefore we can see very little new demand coming forward. So we've got a 34% decline, partly as a result of just the lockdown effect during 2020. And whilst it does come back in 2021, it's a bit of an initial bounce back and then it drifts away again as we enter 22, really reflecting that structural change in the market. And then finally, moving on to the hotel sector, which was actually, looking back to 2016, it was actually an early beneficiary of the EU referendum vote and the fall in the pound that boosted overseas visitor numbers for a year or so and helped to support relatively high levels of investment, start to tail off a little bit, but then was revived again last year. Clearly, the pandemic has hit the hotel sector really hard over the last sort of 6 months, and was also expected to have disrupted starts. We anticipate a sort of 28% decline in the value of hotel starts during the current year. In fact, the industry body, in terms of the impact on the hotel sector and the economy as a whole, the industry body representing the sort of tourism industry fears that actually there could be a £22 billion fall in overseas tourism revenues for the UK this year. Now that increase will in part have been decrease will have been in part been offset by an increase in domestic tourism this year, but the pattern of demand has clearly shifted. So some parts of the country have fared better than others. London hotels, for example, have been losing out, but there's been increased demand for accommodation elsewhere. Likely the boost to revenues of major discount chains, such as the Premier Inn and the Travelodges, will have benefited from some of the sort of disruption and the demand for hotel holidays within the UK this year from UK residents. Now that actually is a positive that will hopefully help to support their major investment programs, which are very much directed at across the UK rather than perhaps in sort of traditional overseas tourist hubs such as London. So actually that will help support of recovery in activity as we get into 2021 and 2022. In fact, we're at sort of 20% rise anticipated for next year, with it remaining firm as we get into 2022. If you then sort of take those various sectors and elements that I've talked about over the last few minutes, and we look at them in the wider picture, you can see that actually the overall impact of COVID and the economic situation on construction as a whole is revealed. We got a 1% decline last year, but that's sort of overshadowed by a sort of 31% decline this year. But a substantial bounce back in 2021. Now you can see from those figures that yes, some of the key sectors I've talked about, such as private housing, offices, hotel and leisure, they all sort of bounce back next year, but not back to sort of 2019 levels. And it's really growth in particularly the government investment side and the civil engineering side, which is expected to be stronger over the forecast period, helping to support a 37% rise in overall construction starts next year and a 5% rise in 2022. Whereas we've got a perhaps more sort of muted picture and gradual recovery on the private sector side of things, reflecting that, as I say, that cautious view of we've got of the UK economy as we recover from the COVID pandemic, but also adjust to life outside of the EU. So all of those factors, I think, will temper the pace of growth in the UK economy, and therefore in private sector and investment and consumer spending and demand for consumer-related areas such as private housing. So hopefully that gives an overall view of how we see things coming forward over the next couple of years. And at that point, I'll hand over to Michael to talk through how things are going to expected to develop on the political front.
Thank you very much, Alan, and really appreciate that update. Thank you everyone for joining. So Alan has gone through some really interesting forecasts there. Obviously, a key part of that is around what is the political uncertainty, the uncertainty around Brexit, the uncertainty around the budget, the economy, and obviously COVID playing into that. And so today I just wanted to run through two key things and bring it more to what's happening politically over the next few months, which is around Brexit, and also the response from Rishi Sunak around the budget and responding to what could happen with Brexit and what is happening with the economy as a result of COVID. So first of all, just so we're all on kind of the same page, I remember fondly the pre-pandemic days of last year where the government was pretty much unable to function because of Brexit. And I'm sure you'll remember Boris coming in to becoming Prime Minister in the summer of last year, replacing Theresa May. And obviously we had a general election at the end of last year to break that political deadlock. And the result of that meant that we left the EU on the 31st of December 2019 with a deal. There was obviously a lot of concern of a no-deal Brexit at that point. And we entered a transitional period that runs from the start of 2020 and will end on the 31st of December this year. And really, that transitional period was about negotiating a future trade agreement with the EU. We've obviously completed the exit process. We're no longer a member of the EU. And just to put it into context of where we are now, we're about 119 days away from the end of that transitional arrangement. But in reality, we're about 59 days away from needing to complete that negotiations for it to pass its way through the European Parliament and also through the UK process. So time is running out very, very quickly. And so what I thought I'd do, first of all, I know there's a little delay in this process. Let's move into the next slide. There you go. Is just to talk around some of the key dates that will be happening over the next few months related to Brexit. And the first one is really next week, kicking off the next round of negotiations between Michel Barnier and David Frost. The UK and the EU have been having these negotiations pretty much every other week since around March. And I think this is around the 8th or 9th round of negotiations. So this is a really key time to be negotiating the final details of that potential deal. And really, the 31st of October is when that agreement needs to be completed. It's not an official date, but the EU have been talking around October, and it fits into where the European Council meetings are going to be taking place. And then early December is when any final agreement needs to be presented to the UK Parliament. That kind of falls under the Ponsonby rule, which gives Parliament 21 days to review any treaty before it comes into effect. So early December is really the last time that the UK government can present that to Parliament. And the real key meeting is the 10th and 11th of December, which is the European Council meeting. So any agreement will need to pass through the European Parliament, and it will also need to go through the European Council to get agreement before it comes into effect. Obviously, 31st of December is the end of that transition period. And then we've got 2021, where a number of member states where certain parts of that agreement are not within the competence of the EU will also need to potentially ratify that agreement. That does not stop the actual treaty coming into effect, but they will need to ratify it at some point during 2021 by their own parliamentary process. Okay. So let's look at a couple of things that are on the negotiating table right now and are the kind of key sticking points. So from the UK perspective, what the negotiation is really focused on at the moment and going into next week with the next round of negotiations is around, first of all, transport and energy trading. So really a continuation of the rules that we currently have in place. That's something that the UK is really focused on at the moment. The conformity assessment of goods, again, continuation of that. So items can be passed health and safety checks in the UK, and again, can then be sold into the EU without having to go through separate checks, which would add significant costs to all goods that we would produce. And the UK is also really focused on the police and judicial cooperation, primarily the sharing of data from the EU to the UK and from the UK to the EU. The big sticking points at the moment is really what the EU is concerned around in terms of when the UK leaves that transition period. Direct potential state aid from the UK into certain industries, which would create a competitive advantage for the UK, which would mean that potentially manufacturers would be more likely to want to be based in the UK rather than Germany or France. And the distortion of competition, which is related to regulatory changes we can make in the UK, particularly around decarbonisation. And climate change agreements. If that was to happen, again, that would create a significant competitive advantage for the UK compared to a number of countries in the EU. And so this is normally called the level playing field, which is what the EU are really prioritising at the moment. On the UK side, we are commonly, or you'll hear Boris talking around the Canadian EU trade agreement that was put in place. And that the UK wants a similar arrangement to what Canada got. There is a lot of differences, and obviously the UK is not Canada. We're highly integrated into the EU, and Canada does have a rather big ocean between it and the EU. But also the export of goods that we have, nearly 50% is to the EU, whereas from Canada it's around 10%. So the EU is particularly concerned around potential changes to that level playing field, which the UK will need to negotiate on in order to get a deal. So in summary on Brexit at the moment, it's still a long way to go on those negotiations, and compared to 2019, where I was far more confident about a deal being put through. I think looking at it at the present, I'm far more pessimistic about an agreement being put in place within the deadlines that we currently have. And given that Boris has already ruled out any kind of extension to the transition process, it does look particularly difficult at present. Okay. Also, I want to just quickly talk around the budget, which is expected in October, along with a comprehensive spending review. There has been speculation that this might be pulled, that Rishi Sunak would actually push it back into the spring, primarily because of the uncertainty around COVID, the end of the furlough scheme, and also Brexit and where we're going to be with that. It's more likely that if that was the case, it will be a slimmed down version of the budget rather than a cancellation overall. Let's go to the next slide. So what you might have seen within the previous budgets from the Chancellor and also the mini financial update that he gave in July is around a story that he's trying to put in place. Initially, it was around protecting people. So the furlough scheme that came out in April, kind of implemented in May, and the significant government spending was around protecting people from COVID. The mini update that he gave in July was really around supporting jobs. So again, we had the Eat Out to Help Out, and we had government funding for hiring people who'd been on furlough. And then really it was around the expectation that coming into Q4, the focus would be on rebuilding. So this is really what the government want to be focused on. It's part of their manifesto commitments. You've got Boris Johnson talking about build, 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 the idea of building back better. This was really going to be the time to focus on that investment. But there's really a number of issues which I'm sure everyone is aware at present, which is around government borrowing, which back in March was expected to be £55 billion for 2020. And then only a month later, it's gone up to 273 billion. And presently, we're looking at almost 300 billion of government borrowing for this year. So at some point, that needs to be paid back. And so it cannot continue with the government borrowing and spending that amount of money. So that's an issue that the Chancellor is obviously looking at. And obviously unemployment at the moment expected to rise to almost 12% during Q4, but also the end of the furlough scheme in October and the concern that a number of people on the backbenches of the Conservative Party have about that. And then we have the uncertainties, which is really around, first of all, COVID, the potential for that to peak again going into Q4, and does the government need to focus on additional stimulus to support that? And obviously Brexit. If the budget comes out in October, we might not be in a position to really understand the full implications of a no-deal situation or what a deal would look like. So looking at what to expect from the budget, it's likely there will be tax increases. Yesterday it was, I think Rishi was seen with some of his notes saying it's not going to be as bad as what people are predicting in terms of increases in corporation tax, but there will certainly need to be the start of that process of increasing taxes, or at least flagging in the years ahead that there will need to be tax increases to start repaying the government borrowing. And as part of the comprehensive spending review, which they're undertaking, if they can start looking at each government department making significant reductions in future years. So rather than doing it in 2020, 21, moving it back to 2022, 2023. So these are kind of the areas that they're looking at the moment. The big problem is the level of uncertainty that we have both within COVID, Brexit, the economy, is making it very difficult to be able to predict exactly what's going to be happening within the budget. So overall, kind of supporting what Allan said, the level of uncertainty we have in the political world at the moment is extreme. We're not completely clear what's going to happen with Brexit. We're not completely clear what's going to happen with the budget. And it's really looking at what's going to be happening over the next few months. And that's it from me. And I'll be looking forward to any questions that people have.
All right, thanks a lot, Alan. Thank you, Michael. I'm just going to have a look and see if we've got any questions. No, we haven't got any questions. So it appears, Alan, Michael, you've done a fantastic job, and everybody's got the answers they were looking for, or not, as the case may be. But I'd just like to give them a couple of minutes. But thank you very much to Alan, and thank you as well, Michael. It's really informative. Hopefully that gives people some answers that they're looking for in terms of how their business is likely to operate, or where they're likely to obtain business over the next couple of years, or even invest their time and resource as well. So thank you very much again. No questions are coming through, gentlemen. So I think we're okay to call it the end. Thank you for everybody that joined us this morning as well. We will speak to you very soon. Thanks a lot. Take care. Thanks, Alan.
Thank you.
Thanks, Michael.
Thanks.